big hello and welcome to RJ Sanderson TV, the May episode. Roy Sanderson along for the ride as always. And Roy, I tell you what, there's probably never been a more important time to be doing this show than right now, with such uncertain economic times and cost of living really dominating the news cycle.
I tell you what, Dave, a month is a long time in taxation and economics, isn't it?
Unbelievable. Since we last met back in April, interest rates have gone up again. And I suppose when we met last time, there was speculation that interest rates had flattened or had peaked. But now, not only have they gone up, and we're going to look at that in a sec, there's potentially more pain on the way as well.
And that affects so many things, Dave, so let's get into it.
Our economic indicators, as we always do, are going to start our news headlines today. And interest rate, as we mentioned, has hit 3.85% after a 25 basis point rise in May. Roy, it's the 11th time that the bank has raised rates in the past year, and it means a lot of pain for anyone who is geared at the moment.
And I've been pretty, I've voiced my opinion that I don't think the Reserve Bank have got this right. Hitting people with loans is not the way to fix inflation. And we'll talk about, I've got some suggestions on how we should fix inflation. It's not necessarily increasing interest rates.
You mentioned inflation, interest rate tied very heavily to inflation, and that is currently sitting at 7%. And this number, although it decreased, it was still above the market forecast of 6.9%. And it's a 30-year high. Well, the 7.8% was a 30-year high. So it's still a significantly high number and something that governments need to address. And
the Reserve Bank have said that their target is 2 to 3%. So we're a long way off that, aren't we?
A long way off. Roy, which begs the question, you're a smart mind. What would you do if you were in the government's shoes at the moment to fix this problem?
Well, I've got a list of items, and I've surveyed quite a number of economists, and this is what we came up with. So reduced government spending is crucial. There's an idea here that we should put a special tax, called a super profits tax, on companies that are doing mining, fossil fuels, but also large profits. We had banking's sector declaring profits in the billions and billions, and I know they only pay tax at 30%. Why not just, if you earn more than $1 billion, an extra 5% tax? Gas production, we're exporting all of it, which means it's more expensive for Australia. Hold some back for us in Australia. Inflation and wage rate rises. The Fair Work Commission have indicated that they're quite happy with wage rates to go up by the same rate as the inflation rate. Well, I know that's logically what you might like, but that's going to feed inflation, so that will be a problem. And winding back spending on infrastructure, construction projects, that needs to happen. And finally, who sets the target of 2 to 3%? Why shouldn't it be 4 to 5 or 5 to 6? And I think that needs to be readdressed by the government and the Reserve Bank.
Some interesting points there that you raised, Roy, and the one thing that is clear is it's a problem that needs to be addressed because, as you say, the idea of hitting mortgage holders with the brunt of the problem doesn't necessarily seem like a logical fix. There are a lot of things that need to happen to fix this problem, and there's a lot of stakeholders involved, as you mentioned. Off the back of that, it's a good time to talk about the budget because that is the one time of the year where governments articulate their spending, and one of the points that you had on your list was to reduce government spending. What did you make of the budget?
Well, interestingly, the budget papers say that they had an $80 billion windfall, one-off. It's a one-off windfall. So what they then did is they spent nearly $76 billion of that to leave us with $4.2 billion surplus. So we've got a one-off windfall of $80 billion. We've spent $76 billion, but not as a one-off spend. We're spending that on projects and expenses that are long-term, which means we will go to a deficit over the next 5 years of $125 billion. And I think what the government should have done, if they were responsible accountants, like running a business, they should have withheld some more of that windfall and said, we need to bank more of that and not commit to long-term spending.
and we're going to have a look at some of the economic indicators around the budget and what their forecasts are over the next few years. But the budget has also thrown up some tax issues, Roy. What's happened from a tax perspective?
I won't read them all out, but certainly these are quite interesting. The instant asset write-off was to finish at 30th of June because it's uncapped at the moment. That goes to 20,000. I think that's a big tick. There's some energy incentives, which is great. I like the fact that there's an amnesty. If you haven't lodged a tax return, you have until 2023 with no penalty. I think that's fantastic. Interestingly, from the 1st of July, the day we get paid our wages, on that same day, you will have money go into your super fund. And the reason that's been delayed until 2026 is we don't have the IT set up yet in payroll packages. They've started the process of hitting tax on superannuation. It's $3 million cap. Anything over $3 million is taxed at 30%. That $3 million is not indexed. So today, not a lot of people have $3 million, but let me tell you, in 10 years' time, there'll be a lot more people with $10 million. The ATO will be undertaking more audits. That's been funded in the budget for the next 2 years. Great for pensioners who can earn additional money, up to $11,800. I think it's silly that that's capped at 31 December. I'd make that unlimited time frame. JobKeeper, $40 a fortnight. Well, $20 a week's not going to go far for JobKeeper, so I'm happy with the others. Rent assistance up is good, 15% above inflation. Aged care workers deserve a 15% increase, and I love the fact that single parents are getting more money up until the age of their children being the age of 14. I think that's a tick as well.
Roy, I wanted to talk about one of those points that you made mention of, and that was the idea that from 1st of July 2026, super and wages need to be paid simultaneously. Now, that's always been a weird thing for me. I think, everyone gets their pay slip and they might check it, and everyone knows how much they get paid, or if you don't, that's a luxury, let me tell you that. But the super, not so much. You sort of, hopefully it goes in, hopefully it doesn't. And, sometimes I'm sure that process must get lost, and we hear this term lost super, which, is usually in a different context, but I'm sure that there's a lack of congruence in that process. Can you talk more specifically about why it's not being introduced 2023? You mentioned the IT stuff, but just from a small business perspective, why is it so difficult to transition quickly?
Well, today, you get to the end of the month and the employer has 3 months to pay that super under the regulations. But the fact is our payroll packages right now don't have the systems in place. So it's all right to say, here's the theory, let's do this. But unless you've got a payroll package that can physically do it, then it won't work. So that's why it's been delayed. The start date had to be delayed. And I'm in favour of the idea, but I tell you, for those of us who are running a business, boy, that makes it a little hard on cash flow, because having that extra 3 months to pay my super means that I can use that money for other things. So it's going to squeeze cash flow for businesses when that comes in.
Interesting. Watch that space. 1st of July 2026. Small businesses, you've got to be ready. The budget, I should say, it also went on to outline some of the economic parameters that we talk about on this show often. And you can see here some of the forecasts are quite interesting. GDP looks set to drop, and we'll talk more about that in a sec, but also the CPI, you can see that's kind of where everyone's focus is at the moment, trying to lower that CPI, and it looks like the forecast is for it to drop. I mean, you've got to take these measures, Roy, forecasts with a grain of salt, because the budget is trying to tell a political story more than anything, as opposed to necessarily a evidence-based story. But the thing that stood out to me on this was real GDP. So the question is, how does that stack up on an international scale? And if we look at the next graph, you can kind of see that Australia's outlook for GDP growth is slow, and it's a weak outlook. If you just, there's a couple of countries listed there, but if you look at that last line, Australia versus the world, we're below forecasts for 2023, 24 and 25, which begs the question, is it, what's the outlook for Australia like in terms of growth and GDP growth?
And critical was the slide before where wage rates, they're forecasting that unemployment goes up. and that an inflation rate has to come down. So, all of those become critical, and it just means the Australian economy, they're expecting to be quite flat for some time.
Interesting that in the news of late, there's been a lot of articles talking about the government's first year in office, and there was some reports from business leaders suggesting that this government is more accessible than the last government. But one thing that they did say that key business leaders of ASX 200 companies are looking for is a growth mindset from the government. So I think that weak growth number is going to become a big issue as we move forward, because the outlook for manufacturing, as an example, or the outlook for what Australia is going to hang its hat on a global scale from an economic perspective, is perhaps a little bit unclear at the moment. Are we an energy provider? Are we a manufacturing hub? Are we a services? Are we tech? Are we IT? Well, at the moment, it's not abundantly clear what we are, other than obviously our commodities market at the moment. But I mean that's got a shelf life. We know that the world is trending towards a different direction there. So Australia's got to be careful that they're not left with a community that doesn't do anything. And I know I'm going on a bit here, but we've seen this in some of the Eastern European countries that relied on local industry, and in a globalised economy that hasn't worked out for them, and there's been big consequences.
What you're saying, Dave, is that exporting minerals is great today, but it may not be there in years to come.
Absolutely, yeah. I mean, that's the first rule of economics, isn't it, Roy? That resources are finite. And they're relatively scarce, so once they run out, that's the world moves on. So Australia needs to be ready for that, and I think that number on economic growth is cause for a little bit of concern. But we'll watch this space. Speaking of cause for concern, consumer confidence. It's a number we look at on this show every month. Now, Roy, interestingly, just a nuance of the scheduling of this show, we've had 2 numbers released since the last time we're on this show. And when we last met, I think we talked about right at the end of the show, do we think interest rates are going to go up again at the next meeting? And we said probably not. Mm-hmm. In the end, they went up. So they went up after the April number was announced. So I think people thought that interest rates had peaked, but then it was clear that they hadn't peaked. And now it looks like they may continue to go up. So the number's gone all the way back down to 79 and just above where it was in February and March. So not a good outlook for, from the average punter out there.
So consumer confidence is driven by a number of things, Dave, but clearly it's linking quite closely with interest rate expectations right at the moment.
Absolutely. Business confidence is, have to look a little bit closely at this graph, is flatlining. It's at 0. So the market is neither not confident nor confident at the moment. But I suppose if you look at it in the context of the previous few months, February, March, it is trending upwards. Not to say that this graph has a particularly clear trend over the last 12 months, but you can see that over the last 3 months, business confidence is trending up.
Yeah, arguably business confidence is in a recession with 2 negative indicators.
Yes, yeah, absolutely. What about property? There's some nice narratives coming from the property market in the last couple of weeks around potentially, some green shoots on the horizon. What do you make of it, Roy?
Yeah, I just thought highlight the Australian capital cities combined, bottom left corner, minus 8.4%. You can see what Sydney and Melbourne have done. So we are down over the last 12 months, 8.4%. And compare that with the next slide. And we look at the last 3 months. So the last 3 months are positive 1.4%. So that's a positive I can take, that the market isn't continuing to decline in capital cities. And you can see that Sydney's jumped up in 3 months, 3%, and some others are just in the positive market.
Yeah, particularly those Melbourne and Sydney numbers are where that trend looks to be reversing itself. So quite interesting there, and watch that space. Obviously, rent is tied to rent is a key metric at the moment that people are talking about. There's a lot of policy suggestions and dialogue going on in this space. What's rent growth been like?
Yeah, at just over 10%. Combined capital's 11.7%. I just thought I'd highlight this because I'm seeing this with our clients and our rental property investors. Rents are definitely going up. I can feel it. That's why I searched for this slide. So 12 months rent growth has been quite high.
How does that? How does the investment market look on the whole, Roy, in terms of the lending that's going on in that space?
Yeah, this is one of the slides that indicates we have a looming housing crisis. And I've said this before, but it's early 2023 to mid 2023. We can look back on this show down the track and see whether we were right or wrong. But let me tell you, this is just investment housing. This is pure, and it's not refinance, just investment housing. Look how it dropped in March, and it's below where it needs to be. It needs to be up around the between 40 and 45%, and it hasn't been there for a long time. We're not building enough houses, investment properties, more specifically, for our growth in numbers that are living in Australia.
Yeah. And that's a pretty clear topic that has come from the budget and has been turbocharged by the budget, particularly with the forecasted migration figures. So both sides of government are really kind of struggling to understand how to solve this problem. And well, I say both sides. There's actually there's almost three clear sides in this, that are formed along party lines, and no real agreement from either party on what to do. But I think, as you say, Roy, the clear thing is that it's evident from that slide is that there is a problem. It needs to be fixed because the demand is currently outpacing the supply, and the outlook for supply is bleak. So perhaps it's something that we might look at in future episodes, because the fix on this is going to be complicated.
And if we don't fix it, the end result is the government have to spend money on social housing, and that's going to spend a lot of dollars of our taxes, and that's going to redirect money and make the budget deficit even worse.
And I think that's generally a good point to make. This idea of market failure, you might hear this concept knocked around. What is market failure? It's when the private sector and the forces of supply and demand don't necessarily provide an outcome that's necessary in the community, and the government needs to step in. And I believe that the market should decide the price on these things, and that government intervention should be limited, which doesn't necessarily suit this particular proposal. So I agree with this idea that there needs to be some bold suggestions put on the table around how we solve this problem from a private sector perspective, and in the worst case from a public sector perspective. And it comes back to that idea of GDP growth and what is the North Star for Australia? What are we actually trying to do? How are we going to get there? I think some of those questions are going to loom large until there is a bolder agenda for what this country wants to do moving forward. Now, again, you don't need to respond to this, but this is the flavour of my thinking at the moment, Roy. Share market, ASX 200, the 3-month graph, reasonably flat.
Yeah, I thought I'd just share this. 3 months, relatively flat. The year to date so far this financial year, 3.2%, 1 year 2%. So really, there's a bit of upside in the future would be the way I look at it, because the market has been flat.
What would you say to the people who sort of see that number, 3.2%? Geez, I could take Commonwealth Bank bonds at a better rate than that, or I could take a term deposit at better than that.
Yeah, but term deposits don't increase in value, Dave, over time. Your money is what it is today, and it's worth less in 10 years' time. So term deposits are not a great investment. What that slide actually tells us is that's the top 200. So if the top 200 includes the best 20 or 30 shares, then there's another 170 or 180 shares that aren't so good. So if you can cut out those ones and only invest in the top 20 or 30, you're going to make a much better return. And that's why you should talk to a wealth manager, because they will do a much better return for you than a lousy 2%.
Bitcoin. I love looking at the Bitcoin graph. It's like the Wild West for me. This is the graph for the last few months. So it's up on the 3-month graph, Roy.
Yeah, and because that website there at the top is specialising in cryptocurrency tax returns, I like to share this. You know, we bottomed out around 20K. We're up now. We got up over 30, and interestingly, our office phones started going off. And people were saying, I'm going to invest in crypto. So it's brought people back into the market, Dave, which is surprising to me because you should only put into crypto what you can afford to lose. It is gambling. People call it investing, but you're at risk. So I'm not recommending it, but I am saying if you're in it and that's your space, go to that website because there's taxation specialists. Very few accounting firms look after crypto investors, and that's one of them.
This is like the best bets of the crypto world if it's like gambling, Roy. Make sure you check your best bets. Make sure you get to cryptocurrency.com.au to do the form if you're going to go into crypto. But Roy, time for a tax tip. You've already detailed all the issues to come out of the federal budget, and you've done it in record time. So what's your tax tip for today?
So the middle one is gift vouchers. A business is allowed to give a gift voucher under $300, so up to $299. It's tax-free to the staff member. The employer does not pay fringe benefits tax on it, and they claim it as a tax deduction. So go out before June 30 for each staff member, and that's not contractors, they've got to be on wages, give them a voucher. Coles Myer, JB Hi-Fi, maybe Village, whatever it is, $299 per employee. And also, we've got dozens of tax tips, and if you're interested in more, go to our website and click on the events page. And in fact, on the homepage, there's a little tab to register. It's complimentary, and on Monday the 26th, we're going to give out about 25 to 30 tax tips for individuals and businesses.
I'm going to put you on the spot here and with a question, but I know you're going to be up to it. Can you give a bit of a basic explanation of what fringe benefits tax is and why it exists?
It exists for the reason that it stops businesses handing things to staff members to avoid tax. As an example, let's say you're on $80,000 and you're taxed on $80,000. So you go to your boss and say, hey, drop my wage to $60,000 and give me a company car worth $20,000. So now you're taxed on $60,000 and you don't pay tax on the car. And that's really what brought it about. But there's lots of other things, you know. What's to stop the employer paying your home loan, your credit card, your school fees for your children? There's so many things that were creeping into the market that they invented a thing called fringe benefits tax that means it's around 48%, so it's uneconomic to pay fringe benefits tax unless you have to.
Right. Okay. So that's the deterrent. So, and correct me if I'm wrong. There are some particular areas where the fringe benefits tax is less, which is what you're suggesting here with the vouchers.
Correct. No fringe benefits tax on a voucher up to $299.
Fantastic information. And as always, some more fantastic information on the way because it's time for Roy's Rage, my favourite time of this show. Roy, where are you going today?
Well, we know that there's a housing crisis looming. I've said that before. We've said it in the last couple of months. We know that in landlords, land tax has gone through the roof. Like some people are paying thousands more. Council rates have gone up. Interest rates are going up. So costs are going up. So my rage is that there's a policy being promoted by the Victorian Greens that says they want to have a 2-year freeze on rents. So if you're a landlord, if they were to get their way, you could not increase your rent for 2 years, and then after the 2 years, you're permitted to have a 2% increase, and then you have another 2-year freeze. Now, seriously, people, we are not a Chinese authoritarian capitalist economy. We are a free market. You cannot put a freeze on rents, not especially when we've got so many costs going up. It's a ridiculous policy. I cannot even believe that somebody would think that that's got credit. So a big kick in the backside to the Victorian Greens. It's a terrible policy.
Bang, bang. Roy goes bang. Very interesting point. And as you say, an extension of that housing topic that we've spoken about earlier on the show. So if you're seeing this clip and you want to hear some more analysis, make sure you watch the full show, rjsanderson.com.au. Roy, just before we wrap and let you go, great local. We love to profile local businesses on this show, and you got a big shout out here for one of them. Big shout out, and not only is it a shout out, but also a benefit for anybody who's listening to this show or watching this show online. It is Dalesford Country Retreats. Go to their website, which is at the bottom. There's a top right corner. There's a promo code. You book for 2 nights and you get to stay a 3rd night for free. So how good is that? And by the way, they have over 100 properties to select all around the Dalesford region, and great area to take a few days R&R. So big shout out to dalesfordcountryretreats.com.au. Dalesford, nice time of the year to go there. Markets on a Sunday morning, you got to love it. Roy, before we go, interest rates, do I dare ask the question, will we be sitting here in June after another rate rise, and will the interest rate have a 4 in front of it? Well, I'm not sure if the Reserve Bank actually listen to this show, and if they do, they won't increase interest rates. But if they don't, I'm fearful they will have another interest rate increase, because the papers released hinted that there's more on the horizon. So I'm afraid to say it, but I think there's another 0.25 going to happen this month. Well, I said it at the start of the show, and I'll say it again. There's never been a more important time to watch RJ Sanderson TV. So thanks very much for joining us on the show. We'll see you again in June.